Welcome back to Investing Talk podcast.
Good to be back.
Today we're focusing on Under Armour. You sent over some interesting articles and reports, and our goal is to really understand what's happening with the company
That's right.
and what that might mean for you, our listener.
We've got a range of information here, from a general overview of the business to, recent performance figures, detailed financial metrics, and a look at what the future might hold.
Okay.
It's a solid collection, I think, to help us get a clearer picture of Under Armour's current situation and maybe where they might be heading.
Okay, let's get into it then. Under Armour, for those who might be new to the name, they primarily deal in branded performance apparel, footwear, accessories, you know the stuff.
Athletic gear.
Exactly.
Yeah.
Think moisture-wicking shirts, athletic shoes. They have some well-known lines like heat gear, designed to keep you cool, and cold gear for staying warm.
Right. Performance focused.
And they operate in what's known as the consumer cyclical sector. Now, being in that sector, what does that practically mean for Under Armour, especially right now?
Well, that's a really key question. Companies like Under Armour in that consumer cyclical space, their performance is often, pretty closely tied to the economy's overall health.
Okay.
When things are good, people have more money to spend. They tend to buy more non-essential stuff like athletic wear.
Makes sense.
But conversely, during downturns, those are often the kinds of purchases people cut back on first. So yeah, Under Armour's results can be quite sensitive to those broader economic trends.
So speaking of results, what's been going on with their stock lately? Has it been reflecting that sensitivity?
Oh, definitely. Their recent stock performance is quite notable. As of early April 2025, the price was hovering around $5.36.
Okay, pretty low compared to its history.
Well, exactly. If you look at the past year, it's been, a bit of a roller coaster, trading anywhere between $5.30 on the low end and $11.89 on the high end.
Wow, that's a big swing.
It is. That really highlights the volatility around the stock, and we've definitely seen a downward trend over the last 6 months or so.
And that's linked to?
It seems likely linked to the recent earnings reports and, some of the broader challenges the whole retail industry is facing right now.
Right, okay. Let's delve into those earnings then. What are the actual financial numbers telling us?
Okay, looking at their financial health, their revenue over the past year, the trailing 12 months is approximately $5.32 billion. However, when we zero in on their most recent third quarter, fiscal 2025, revenue actually came in at $1.4 billion.
And how does that compare?
That's a 6% decrease compared to the same period last year.
Ouch, okay. A drop.
And just for a bit more context, their total revenue for fiscal 2024 was $5.7 billion, and back in fiscal 2023, it was $5.9 billion.
So yeah, you can definitely see a pattern there, a clear decline over the past couple of years.
You can.
Now, how has this slide in revenue impacted their profitability? Are they still making money?
Well, that's where it gets tougher. This revenue decline definitely puts pressure on the bottom line. For the trailing 12 months, they actually show a negative net income.
Negative? How much?
Minus $127.24 million.
Wow.
And their earnings per share are also negative at minus $0.29. So this significant loss, over $127 million, it really underscores the challenges they're facing in, turning that brand strength into actual profit.
So for listeners, that essentially means the company is currently burning through cash.
Pretty much,
Wow.
Which puts pressure on turnaround efforts, future investments, everything really.
And looking ahead, what are they projecting?
The company itself anticipates a diluted loss per share for the entire fiscal year 2025 to be somewhere between $0.48 and 30 cents.
Still a loss then.
Still a loss on that basis. Now, on an adjusted basis, they're projecting diluted EPS of $28 to 30 cents.
Okay, adjusted positive. What about the PE ratio?
Well, given the losses, the price-to-earnings ratio is negative, around minus 16.7x.
Which basically signals no current profitability.
Correct. It tells you the company isn't profitable on that standard measure right now.
Okay, so revenue down, profitability negative. Are there any positives on the financial side? I thought I saw something about gross profit margins improving.
Ah, yes. That's a really important point to highlight, actually. Even with the revenue decline, the fact that their gross profit margins are reportedly getting better is encouraging.
How so?
It suggests that maybe their efforts to manage the cost of the goods they sell are becoming more effective. It could mean better pricing strategies, maybe, or improvements in supply chain efficiency.
So something's working on the cost side.
Potentially, yes. That improvement in margins is definitely something to watch in their future reports.
Yeah.
Is this a sustainable trend? Can they keep it going?
We also have their debt situation, right? How leveraged are they?
Yes, their debt-to-equity ratio is currently around 30.0%.
And what does that tell us? High? Low?
It gives us an idea of how much they're using borrowed money compared to shareholder equity. 30% suggests, well, a moderate level of leverage.
Okay, so not excessively high.
Not excessively high, no, but it's definitely something to keep an eye on, especially with the current profitability challenges.
Right. And free cash flow. Any numbers on that?
We don't have specific recent SCF figures from these sources, unfortunately, but it is worth noting they expect to spend between $170 and $180 million on capital expenditures for fiscal 2025.
Okay. And free cash flow, just to remind folks, that's crucial because
Because it shows how much cash they actually generate after covering operating costs and those capital expenditures. It's the cash available for paying down debt, reinvesting, maybe shareholder returns down the line. So it's key.
got it. So if we take a step back, look at the big picture. What are the main red flags that really stand out here?
Well, the declining revenue is definitely number one. And the fact they're currently operating at a loss, those are the most prominent concerns, I'd say.
The negative net income and EPS.
Exactly. Those clearly indicate financial strain. And as we mentioned, the volatility in their stock price also reflects all this uncertainty about their future performance.
But it's not all doom and gloom, presumably. What strengths does Under Armour still have that they can, leverage?
Absolutely not all doom and gloom. Despite these challenges, Under Armour still possesses really strong brand recognition. And they have a loyal customer base.
That's a big asset.
It's a significant asset, especially in such a competitive market. Plus, as we just discussed, that reported improvement in gross profit margins suggests their strategic efforts might be gaining some traction.
You mean the sell less, earn more strategy, focusing on reducing discounts?
Precisely. That focus on profitability over just pure volume might be starting to show some positive effect on margins.
But improving margins is one thing. Selling less while earning more, that sounds like a tough balancing act.
Oh, it's incredibly tricky. They need to keep the brand appealing without relying on those deep discounts. It's a tightrope walk, especially in this market.
So that's another key area to watch.
Definitely. Are they sacrificing too much volume for those margin gains? Or can they find the right balance? Future reports will tell.
Okay. What's the general feeling about Under Armour from analysts and the public, people who follow the company closely?
It seems to be a mix, maybe cautious optimism alongside ongoing concern. The general analyst consensus seems to be a hold rating.
Hold, so not a buy, not a sell.
Pretty much middle of the road. The average 12-month price target is around $9.07.
Which is quite a bit higher than the current $5.36.
It is. It implies potential upside, suggesting that, on average, analysts see some possibility for improvement or recovery.
Oh.
And interestingly, the market reaction to recent earnings, despite the revenue drops, was somewhat positive in the short term.
But you mentioned public sentiment is more nuanced.
I think so, yeah. If you look at discussions online, investor forums, you find a real blend. Lots of people still believe in the Under Armour brand, its potential. They see that customer loyalty.
Right, the core fans.
The core fans. But that optimism is definitely, tempered by these very real concerns about the financial performance we've been discussing.
And not all analysts are on the hold train.
No, you also see contrasting views. Morgan Stanley, for example, has an underweight rating with a much lower price target of $4.
Okay, so quite a divergence there.
It really underscores the significant uncertainty surrounding the company's path forward. Big difference between a $4 target and a $9 target.
Let's talk competition. How does Under Armour stack up against its rivals? Who are the main players they're fighting against?
Well, in athletic apparel and footwear, it's intense. The reports mention Hanesbrands and Levi Strauss specifically as competitors.
Okay.
And while there have been times Under Armour outperformed peers like these, overall, the recent financial results have generally been weaker and certainly more volatile.
And beyond those two?
Oh, the market for performance gear is incredibly crowded. You've got the giants, obviously, Nike and Adidas. They're constantly innovating, competing fiercely.
Right, the elephants in the room.
Absolutely. For Under Armour to really succeed long-term, they need to consistently differentiate themselves and, crucially, execute these strategic plans effectively.
So, thinking about differentiation, when you walk into a store, how does Under Armour try to stand out against Nike or Adidas? What's their hook?
That's a great question. I think historically they built their brand on that core performance innovation, especially with fabrics. The moisture-wicking stuff was revolutionary at the time.
Yeah, heat gear, cold gear.
Exactly. They really need to keep pushing that kind of innovation edge and connect authentically with athletes, at all levels, not just the pros.
So looking ahead then, what are the key things we should be watching for? What could be positive catalysts for the company?
Well, moving forward, their future earnings reports are going to be absolutely crucial. Investors will be glued to those,
Looking for?
looking to see if that trend of improving gross margins continues. And critically, can they stabilize and eventually start to grow their revenue again? That's the big one.
And the restructuring plan.
Yes, the successful implementation of their ongoing restructuring plan is another major factor. If they can genuinely streamline operations, become more efficient, that should boost profitability.
Okay. And on the flip side, what are the potential risks? What could derail this turnaround attempt?
There are quite a few, honestly. The current challenges in the retail environment, particularly in North America, that's a big risk. Consumer spending habits.
Yeah, influenced by inflation, interest rates.
Exactly. All those broader economic factors can definitely impact demand for their stuff. Any new regulations affecting the apparel industry could also pose challenges.
Anything else specific to Under Armour?
Well, we know they're dealing with expenses from litigation settlements that will hit their financials, and global supply chain disruptions, while maybe easing slightly, are always a potential risk for getting products made and delivered efficiently.
And ultimately?
Ultimately, as we've kind of circled back to a few times, the success or a failure of that sell less, earn more strategy is just fundamental. Can they make it work without alienating customers or losing too much market share?
It seems like there have also been some pretty significant changes in their leadership recently. How might that play into things?
That's right, yeah. The return of Kevin Plank as president and CEO, effective back in April 2024, that's a major development.
The founder coming back?
The founder's back at the helm. He obviously brings a strong vision, a deep understanding of the brand's DNA.
And other new faces, too.
Yes, they brought in new leaders for key roles. Yassine Saidi as Chief Product Officer, Cara Trent as President of the Americas.
So shaking things up at the top.
It often signals a renewed focus, an effort to bring in fresh perspectives, drive new strategies. It suggests they know changes are needed.
And they made an acquisition, too. Unless collective.
That's right, a company focused on sustainable fashion. That's an interesting move.
How does sustainability fit into their strategy? Does it align with performance wear?
Well, it could be a strategic effort to tap into that growing market segment of environmentally conscious consumers. People who increasingly prioritize sustainability even in their athletic gear. It could attract a new audience.
Interesting angle. Okay, so as we start to wrap up this discussion on Under Armour, what's the key takeaway for you, for our listener?
I think what we've seen is a company with a really strong, very recognizable brand, but one that's currently navigating some, frankly, significant financial headwinds.
Yeah, the numbers aren't great right now.
They aren't, but they are actively pursuing a turnaround strategy. And there are mixed signals in the data. Those improving margins offer a glimmer of optimism, but it's against that backdrop of declining revenue and overall losses.
And the market reflects that uncertainty.
Absolutely. The varying analyst opinions, the stock price volatility, it all points to that underlying uncertainty. This situation really, I think, illustrates the complexities of investing.
How so?
It's about carefully weighing the strength of a brand, its history, its future potential, against the cold, hard, current financial realities and all the market pressures.
A balancing act for investors, too.
Definitely. So we'd encourage listeners to keep these points in mind as you continue to follow Under Armour and the broader market, too. It's very much a story that's still unfolding.
And the results of these strategic moves, the leadership changes that sell less, earn more, push, the coming quarters will be really telling.
Extremely telling. We'll see if the plan starts to bear fruit.
Okay. Well, if this exploration into Under Armour has raised any further questions for you, or if there are other companies or topics you'd like us to examine in future discussions, please do let us know in the comments.
We'd love to hear from you.
And of course, if you found this informative today, be sure to subscribe, like, and maybe share this content. It really helps us out.